Go.
Welcome everybody to our next Google Hangout for asset pricing on Coursera. I'm John Cochrane, the guy who teaches the class. Let me introduce who's here. We also have, let's see, Nina from St. Gallen, one of our TAs. Nina, say hi.
Hi everybody, I am TA for this awesome asset pricing course and I'm right now in St. Gallen. It's my pleasure to talk to you all today.
And Adam, say hello.
Hello, everyone. My name is Adam. I'm at University of Chicago, and I'm also a TA for the course.
And Igor.
Hi, guys. Igor is my name. I'm sitting in the next room from Nina in St. Gallen now. I'm 24, and I'm doing a PhD in finance here.
Welcome. And Charlie, say hi and introduce yourself.
Hi. I'm a fourth-year PhD student at University of Connecticut, and I'm doing research in empirical asset pricing. So enjoying the class so far.
Excellent. Okay. Adam, should we just start in with questions from our visitors? We're going to do this. We're going to try to do this like radio call-in show today and see how that works. So why don't we start with Igor, since you signed on first. Igor, you got something for us?
Yes, I would have a question. This one has been bothering me for quite some time now, and finally I'm asking it. In one of your papers, I guess it was about the dog that did not bark, you mentioned this predictability issue, that either the returns or the dividend growth have to be somehow predictable. Otherwise, the DP ratio stays constant. It seems a little bit vague to me, so could you please elaborate on that? Why is it like that? Why do we have this predictability phenomenon?
Yeah, this is a great question. Now, I will turn this into a little bit of an advertisement for the second half of the course. This year I expanded the class, and we're going to do a whole week on revisit the time series predictability that everyone saw a little bit in week one, and we'll see that identity. But as it is kind of an amazing fact. You sort of think returns could be unpredictable. Sure, coin flip, dividend growth, looks like a coin flip. But that implies, if that's true, then the price-dividend ratio is constant. Now, why? Intuitively. Let's just think about prices. If every morning, prices are the expected future value of something or other, right? Discounted payoffs, but expected future value. If the world is IID, if every morning you wake up and good or bad things happened last night, but looking forward, the expected future is the same. The expected future return is the same, the expected future growth in cash flows is the same, then the price has to be the same every morning. Because even though the past may differ, there may have been a flood yesterday, an earthquake today, sun the day tomorrow in the past, if the conditional expectation of the future looks the same, prices have to be the same. Now, price-dividend ratio, now let's just slip a derivative. If expected dividend growth is the same, the level of the dividends can change. Then the ratio of prices to today's dividends has to stay the same. So that's the intuition. You can go look up the identity for the math, but I think the intuition is a strong one about, but what it really reveals is what the central nature of asset pricing. It's forward-looking. So what matters is the expectation of what's going to happen in the future. If variables are IID, that expectation is always the same. Prices have to be constant. Prices aren't constant. And so I think that alone is just a dramatic, the fact that the price-dividend ratio varies tells you we don't live in an IID world. Expected something or other is changing a lot over time. Either dividend growth or returns turns out to be return. Good question. Charlie, you got one? Or
yeah, well, I can kind of follow up on that. So I think that paper, and I really liked the way that John brought up predictability and discount rates when he said, look, it has to predict dividend growth or returns. Right now, the point estimate is all returns, no dividend growth. So forget about the T statistics so much. Like, why would we assume the opposite is true? All the evidence is pointing this way. But I think a lot of people have this question of how do we square this, and it's come up a couple times, so I apologize for repeating, but you know, how do we square this with when Goyle Welch go back and look in sort of a no peaking way, like how robust are these models, how much do they predict out of sample? You know, we don't. So we aren't very good at like we don't have a model sort of in real time that tells us very well what expected returns are going to be tomorrow. But we have a lot of evidence that expected returns vary over time. So I guess like a couple times John has tried to like sort of summarize that for us. So maybe take one more shot and contrast it. I asked John Campbell this question, and I think he gave sort of a different answer than John. He said, look, I wrote a paper in that same issue of RFS. It said if we just make some like really simple economic assumptions like expected returns don't go negative, now we get statistical significance. So he was sort of saying, look, we make these simple assumptions, we get statistical significance. But I think John's response has been more, maybe we live in a world where we know returns vary over time, but they're sort of hard to predict robustly. So I don't know if that's a fair summary. If it's not, you can clarify, maybe.
That's a good fair summary. Again, the game in life is not to get your magic T statistic above 2.1 and then send it to the Journal of Finance. And I think Goyle and Welch would say, well, you can have the statistical argument forever, whether the T-stat is 2.3 or 1.9. The fact is, the return predictability is hard to put in a model that works really well out of sample in real time based on the data we have. It's getting better all the time. This afternoon, Peter Kujis, I'm at Stanford now visiting for the year. Peter Kujis is going to give a paper on dividend yield predictability in the 1600s. So working the data back to the 1600s, that should improve our T-stats. So it is going to be a phenomenon that's going to be hard to detect statistically. It's going to wander around through time. I think right now, is the price-dividend ratio high or low? Well, there's this suspicion that, well, this time we had a one-time shift in the level of dividend yields. It is a very slow-moving phenomenon. Not just dividend yields. Dividend yields, remember, is only the tip of the iceberg. But all of the other forecasters are at least business cycle frequency, if not lower. So this is a phenomenon you see maybe once every 5 or 10 years. Hard to accumulate a lot of data points on that phenomenon. So I think it's fair, but I think that's exactly predictability. Always is in the hardest corner of things to square. It's the thing that is hardest for both rationalists and behaviorists to make sense of. In this sense, it is so you're not going to get them. I think it's good to summarize. There's not going to be an easy model that you can trade for profit and start your hedge fund. If so, it would have gone away. Nonetheless, the point estimate is strongly in it looks like 100% returns, 0% dividend growth. So I think for building our models of how the world works, that seems like a reasonable place to start. You have to. The counter argument is, night really is day, day really is night, but the T-stat's only 2.1, so maybe we're all, we get the lights on at the wrong time of the day. That's just with the world. So let me try to summarize. I was going to do short answers today, and I so far failed. I think we're in a world where predictability is. It's hard to make models that work out of sample that you could trade on and make a lot of money. Nonetheless, our point estimates are that variation in prices is largely driven by expected returns, and then take the implications of that for where they go. I probably didn't help you that much, Charlie.
No, I think that's fine. I think that's good.
Adam, how are we doing? Do we have time for a second one from Igor and Charlie, or should we move on?
We have time for a brief question, and then I think we have other students coming in a couple of minutes, hopefully, if it works.
Okay, maybe Igor got a second question?
Yeah, sure. That'll be a brief one. Yeah, going on with predictability. Might it be an issue with the predictability of expected returns versus the predictability of returns themselves that keeps the people so uneasy about it? I might be wrong, but it seems to me like predicting expected returns is kind of easy, but when we go into the returns, the actual returns, that's where the whole point starts, right?
Well, I think a good way to translate that question. So predicting actual returns and predicting expected returns is in a sense the same thing. But another way of stating, I think, what the intuition you're getting at is that the R squared is very low. And so when you're another one of these puzzles about predicting returns, if you're predicting the weather, it's not very satisfactory to say I predict 61, well, let me do it in Celsius. I predict 21 tomorrow and it came out 30. I predict 19 tomorrow and it came out 0. I predict 22 tomorrow and then it comes out 45. You'd say, boy, you're getting the sign right, but you're doing a terrible job because your R-squared is very low, right? Now, return predictability is like that. The R-squared is low. The fraction of the actual return you can predict is low. So this is one of the reasons people laugh at you who don't really understand what we're doing. You say, I think expected returns are high, and you know, it's like my example. You're saying, I think it'll be 8%. It comes out to be 45%. And they say, well, you don't know much. But for the interesting thing, which I think I tried to emphasize in the first lecture, the variation in expected returns is quite high compared to the level of expected. So the R-squared can be low, but the amount of explained variance relative to the level is very high. And that makes it a very interesting phenomenon despite the low R-squared. So the low R-squared, and these tie together. The fact that the R-squared is so low is part of why it's so hard to detect statistically. But R-squared is the wrong measure for our purposes. I hope that got somewhere. Guys, stop asking such hard questions. Charlie, maybe you get a second one. Thank you, Igor.
I do. I mean, so I have this problem that all my questions are empirical because that's the work that I do. But in this week's lectures, we did the mean variance efficient frontier, and I know you briefly mentioned, and we'll talk about it more, that there's this mapping between factor models and mean variance efficient frontier, and I find that in the empirical literature, I don't have a very good sense. I've never seen, for instance, no one takes the Fama-French 5-factor model and say, okay, what's the mean variance efficient portfolio? And I know in a sense that, like, okay, I do a GRS test and it sort of does this, but I don't have a very good intuitive sense about the mapping. And, you know, when I write down a factor model, especially when I write down one just for equities, you know, that should in theory price everything, and the mean variance efficient frontier would have many assets. Should I be asking the question, what's the mean variance combination of these 5 factors or 3 factors, maybe, if you have a different model? You know, how should I take this lesson from this week into more empirical work that we see a lot?
Number one, I think it's an integrative. So for me, that theorem, so let's review for everyone else what the theorem is. You have a 5-factor model that seems to price assets. The theorem is that there is a single factor, the mean variance combination, efficient combination of those 5 factors, and that single factor will price assets just as well, the same way the CAPM prices factors. So that's our theorem, our friend the roll theorem. Now, what do we do with that? One thing that insight did for me is I read lots of papers that are testing for the number of factors. And I go, guys, that's a silly thing to test for, because for a 5-factor model, there's an equivalent 1-factor representation. Roll theorem says so. So the raw number of factors doesn't seem like that interesting a question. So I found the theorem useful that way. It is true that people don't often construct the mean variance efficient combination of Fama-French factors. Although I suspect, I'm not in the know, I would be surprised that, like, Dimensional Fund Advisors doesn't do it. You know, if you're in the business of selling these 5 factors portfolio, somebody's got to put together how much value and how much small should we have in our portfolio, and that's the question. If you're a mean variance investor, which combination should you hold? So it might be useful for that reason. Now, what you suggest here is an excellent quiz question. Where does the number of factors matter? Why do Fama and French use the 5-factor representation and not the equivalent mean variance efficient? Why have they never written that one down? Yeah, there's 10 French calling you right now, Charlie, to object. And this is important to distinguish models of mean and models of variance. So what happens if we take the 5 Fama-French factors and instead use the single implied mean variance efficient frontier? Well, 2 things will happen. One, that thing is going to be less stable in sample, because just which combination of the 5 will wander around. It's hard to measure that. The second, you're going to lose intuition. So I asked Fama this question, and he said, why don't I do that? Because I lose intuition. What I see is when we do the 5 factors, we see all the value betas moving up with the value stocks and the growth betas with the growth stocks, and that shows you it gives a sense of robustness. And when you read Fama in French, you get this glorious sense of they want the results to be robust and intuitive. That's another reason to do it. The third and most important reason, I think, is this difference between models of mean and models of variance. So if we take the 5-factor model and collapse it down to the 1-factor model, it will have the same pricing errors. It'll have the same alphas. The betas will lose all economic intuition. And the R-squared in the time series regression will go down. We will not explain variance as well as we would with the individual 5 factors. So they like models that explain variance as well as models that explain mean. And I think that's the reason for sticking with the 12 factors. Now, for those of you who found all of this completely confusing, I was yesterday running through the lecture that's going to discuss factor models. That's going to discuss the Fama in French paper in great detail, and the econometrics of doing the Fama French paper, and that of doing factor models. So if you think what Charlie and I were talking about sounded interesting but completely confusing, hang in there. We'll get there. Charlie, by the way, thanks for calling in. It's great to get to know you in person.
Great. Yeah. Thank you.
Good luck on that. Adam, what do we got next?
Yes, we have Deepanshu. Deepanshu just joined us. And before we get to Deepanshu's question, I just want to tell each of you again that you can mute yourself at the top of your screen and unmute you again. So right now I can see Igor and Deepanshu, you are muted.
I have muted Deepanshu because noise was coming from him. So
okay. But why don't we... Deepanshu, can you unmute yourself again? And then you're welcome to ask a question.
Welcome back, Deepanshu.
Hello, Professor. It's nice to meet you again. I have a question from your paper on...
Wait a minute. Can you introduce yourself? Because you're being broadcast to the world. So just introduce yourself to all the other students who are listening. And we'll go with questions.
Okay. My name is Deepanshu, and I'm a student at IIT Kanpur. And I'm an undergraduate in mathematics and statistics. This is my second Google Hangout with Professor Cochrane. And okay, so my question is from your paper on mean variance portfolio payoff. And in that paper, you were trying to optimize the mean variance characterization and CAPM equilibrium pricing, right? So you say that markets are incomplete and returns are not independent and identically distributed. Now, you go on utilizing the mean variance from the Markowitz theory, and underlying assumption in the Markowitz theory were that the returns were specific to everyone and everyone had the same information. So same information makes these return variables independent as well as identically distributed, which are in contradiction to your theory that markets are incomplete and so there are no identical distributions. So how is using mean variance as a comparator of beta valid?
Okay, that's a good question. And so now for everybody else, I really appreciate that this class is so easy that you guys have time to go read all my other papers and ask questions about them. Actually, I do appreciate that. So this paper, for people who don't know what we're talking about, I think you're referring to the, gosh, I can't even remember the titles of my own papers now. Mean-Variance benchmark for dynamic portfolio optimization or something of the sort,
Yes,
which is a paper that I'm delighted you brought it up because I didn't think anybody had ever read it, but I think it's really cool because it thinks about, the good part about this paper is a long sermon about how we ought to think about portfolio theory in terms of lifetime flows, not in terms of one period mean variance efficiency. And I've told the joke in the class over and over again about the bond investor who forgets that when the price goes down, the yield is going to go back up again. Okay, so that's the paper. You ask an important language question. In that paper, I allowed returns to have Expected return and standard deviation of return can vary over time. It's a world in which returns are not IID over time. And usually that sets up all sorts of market timing and hedging portfolios. Those of you who don't know about this, the last week of the second class, we're going to do portfolio theory. And I'll show you, but it's fairly common sense. If expected returns are higher and lower at different times, and you ask the portfolio question, then a mean variance portfolio investor will say, hey, I want to put more in when returns are higher and lower, and there's hedge portfolios and all sorts of complexity. Okay, so that paper it said returns are not IID, expected returns can vary over time, and will do mean variance. Markets are incomplete. It also said that the information is the same for all people. Now, one of the other assumptions we sometimes don't want to think about is that I know something and you don't know something, and therefore we might buy or sell stocks from each other, as opposed to common information, which is where we all have the same information, so we might all want to buy and sell, but we're not going to trade a lot with each other based on different information. So the confusion you're making is you're confusing information being the same across people and information being the same over time. So we can have a world that is not IID, and that expected returns vary a lot over time, but they don't vary a lot over people. So that we wake up in the morning and everybody knows it's going to be a rainy day. You can have a weather where sometimes it's rainy and sometimes it's sunny, and everybody knows it, as opposed to a situation where some people think it's going to rain and some people think it's going to be sunny. I hope I answered that in there somewhere.
Yes, sir. So there is another question that when you use the Markowitz theory, you are essentially using the assumptions that Markowitz used to calculate the beta, and which were exactly the independence of the random variables. That's how he calculated returns against the pricing. So isn't that simply contradictory?
Let's see. I'm trying to put together. Well, there are a number of different ways to derive the mean variance. So what are we deriving? There is always a mean variance efficient portfolio. That doesn't take any assumptions. I guess it just takes absence of arbitrage. A second theorem that we sometimes derive is when does an investor want to hold a mean variance efficient portfolio? That is the set of assumptions behind the CAPM. One way to do that is by giving the investor power utility and lifetime power utility and IID returns. Then he wants to hold a mean variance efficient portfolio. That may be the one you have in mind. But there are other assumptions of the CAPM, other reasons for holding mean variance efficiency that don't require IID. So, for example, log utility, the CAPM holds with log utility and non-IID returns, or quadratic utility. The first derivation of the CAPM I did was quadratic utility. It's a one-period model, so it's a IID or non-IID doesn't matter at all. So this is a good example of how in finance often there are different sets of assumptions. There's no one-to-one mapping of assumptions and answers. So desire to hold a mean variance efficient portfolio, there's at least 3, if not more, derivations that give that. Quadratic utility with two-period investors, IID utility and long-term investors who are, IID returns and either long-term investors who are log or quadratic utility, sorry, let me do this again. Quadratic utility, IID returns and log and power utility or log utility, but the quadratic and log don't need IID returns. So long-winded answer, but on to the next. Adam, you're in charge of the radio figure. Thank you, Deepanshu.
Yeah, so we have a new student with us, Jawhar. So Jawhar, why don't you introduce yourself to the world, and if you have a question for Professor Cochrane, please ask.
Okay, I'll just wait.
Can you hear me?
Yeah, of course, I will wait for Mr. John to finish what he is talking about.
Okay, I'm done now. Are you watching? I hope you're not watching. The YouTube stream is delayed, so watch us on the Google Hangout, where we're certainly seeing you.
Jawhar, can you hear us?
Yes, I'm hearing you.
Yeah, so you are welcome to ask your question now.
Okay, thank you very much.
And why don't you start out by introducing yourself?
Okay, it's Jawhar. I'm a third-year student in finance at the. I'm sorry. I am watching it.
You shouldn't watch it on the YouTube channel. You should watch it on the Google Hangout screen, because the YouTube channel is a little delayed.
We can hear you well, so you can just talk and introduce yourself and ask your question.
Yeah, je sais. Carthage. Donc, I just want to answer, to ask this question. What if the investor is a firm? It's not a consumer. How can we draw the utility function?
What if the investor is, I'm sorry, is what?
What if the investor is a firm, is not an individual?
If the investor is a firm, okay, that's a very.
How can we build a utility function of the consumption? Yeah. Because okay. the one who will take the decision is not the one who will consume laterally.
Yes, absolutely. Okay, this is a great question. Now, how can I answer that in less than an hour? You've touched on one of the most important questions in finance. Let me give you the answer that you're not going to like, because it's as always, we start with the frictionless world and the Modigliani-Miller theorem, and then we layer back reality into it. So in the frictionless world, in the world we're studying, remember we're starting in the simplest possible world, firms are owned by people, and firms have no utility functions per se. So let's think about what firm the firm might be. If the firm is a classic company that builds things, the company acts on behalf of its stockholders, and all of what they teach you in corporate finance doesn't matter. In other words, the firm does what the stockholders want it to do and invests optimally. And furthermore, firms aren't really that important. The firm, if it has a factory, it invests optimally in the factory, but it doesn't try to do portfolio decisions, because the investors can do their own portfolio decisions. So rather than have a company put your money into a diversified portfolio of stocks, the company should just build its own factory, and then you can hold a diversified portfolio of other stocks. If the firm you have in mind is a management company, like a money manager or a hedge fund or so forth, again, the simplest, we can start by thinking the firm just takes its decisions on behalf of the investors, in large part because investors can undo those decisions. So if you're invested in a mutual fund and that mutual fund buys too much Apple, well, you just short Apple, and then it doesn't matter. You're holding, you can always undo anything that the company does. So in the simplest way of thinking about things, companies don't matter at all, because they are acting only, all company money eventually goes through as dividends or interest to its fundamental owners, and only people have it. Now, of course, that's wrong. That's the theory of asset pricing. The theory of corporate finance says, wait, that's wrong. Why? Because the underlying assumptions fail. For example, bankruptcy costs. So what I kind of told you was the Modigliani-Miller theorem, and one of the reasons that might not work is bankruptcy costs. So, for example, a prediction of the model I just told you is that companies should never hedge. There's no point for the company to hedge oil price risk, because the investors can hedge oil price risk. But if the company goes bankrupt, then there's going to be a lot of lawyers' fees involved, so it actually makes sense for the company to hedge oil price risk. So that's an example of how, the way we always do things. We start with a very simple model where everything's frictionless, companies don't matter, and then if you want to study corporate finance issues, you describe what the friction is, the bankruptcy costs, and then you can start thinking about why who's making the decision would make some difference. But that was a great question. Adam, I'm going to put you back in charge of being our MC. Who's next?
Good. I think.
Also, Adam, Adam, you've taken a lot more corporate finance than I am. If you had something else, if I should do something different, Nina too. I'm sure they make you take lots of corporate finance. And Charlie, should we say something else about the nature of the firm and who makes decisions in asset pricing?
I mean, my take on this is that we might have been taught in graduate school that asset pricing and corporate finance are two different courses, and they care about two very different types of finance. And I think that might be too old school. In fact, I think that we need to understand how margins affect broker-dealers, or how liquidity risk is priced in. So a lot of the research that I'm trying to do sort of takes principles from corporate finance and applies it in asset pricing. Because in the end, one of the things that we really care about is aggregate fluctuations of wealth and consumption derived from, for example, asset pricing. But I think that the recent crisis has taught us that precisely as you just said, it's important to think about when potentially the Modigliani-Miller theorem fails.
So let me, Adam is exactly right, and for everybody who's thinking about things, right now one of the most active areas of research is in fact to find these places where corporate style frictions can affect asset pricing. And the classic story is the one Adam told. Suppose that there's an active market going on like fall of 2008, and the broker-dealers who are buying and selling stuff run out of money. They're highly leveraged, and then they stop buying, and they want to sell things to raise capital. Can that cause a fire sale? Now that's a story that's told a lot, and in that story, the decisions of a company, the preferences of a company, start mattering to asset prices. Now, where's the contrary? The contrary theorem would say, well, if they want to sell, then you and I just jump in and buy. We see, your fire sale is my buying opportunity. And not just us, university endowments, Warren Buffett, the Norwegian Sovereign Wealth Fund. The minute the broker-dealers start to dump stocks, we buy them, and then the prices depend on individual preferences, not on this corporate decision. But of course, we weren't there. In fact, at least in the short run, markets do seem to be a little bit segmented, and then we've described the friction, and now the preferences of these broker-dealers can matter. So that's just a story to keep in mind for exactly the kind of stuff that is really hot in the research world right now. Thanks. That was important to bring up. Nina, and anything we should add to that?
I have nothing to add here.
Okay, thank you. What's next, Adam?
Is there any questions, follow-up questions from Charlie or Igor or Deepanshu? Because otherwise we haven't had any questions from the forum, but we wanted to. Do you guys have anything to add? No.
Okay, good. We'll do that for the questions from the forum. This will especially help. I'll try to give an answer, and then if the three of you guys have something that I didn't answer clearly enough, then you can call me on it. Okay, next question from the forum.
Okay, so the first question is from Bryant. He's a software engineer from Boston, and he has done master in mathematics and computer science. He said that you, John, have mentioned vector analysis in the end of last Hangout. And Cliff asks, could you please talk about any factor analysis or principal components work that has been done in trying to identify relevant explanatory variables in stock market prices? You alluded to a zoo of factors at the beginning of the course. Had there any work along these lines been done to try to make sense of the zoo? Yeah.
Go ahead.
There is a second question, but better I don't say it now.
One question at a time. I'm not that fast.
Yes.
So yeah, that's a big question. So let me. Factor analysis is so we use one thing everyone should be aware of. The word factor has about 10 different meanings in finance as well as outside of finance. And so when someone says find factors, you have to think hard to understand which of these meanings they're talking about. Factor analysis means trying to find common sources of variance. The simplest form, which we'll do in a problem set soon, you take a covariance matrix, you find its eigenvalue decomposition, and you find the linear combinations of the returns that explain the most variance. We'll see that in the Fama-French context soon. So lots of factor analysis that has been done to try to find the sources of common variation in stock returns. And then they find the things you might expect, the market, industry, components, and so most of the commercial risk management models, like the Barrow model I'm aware of, is essentially that kind of factor analysis model. The second use of the word factor is things that forecast returns. So price-dividend ratio you've seen, the book-to-market ratio, the size of a company in momentum, the company's recent performance. Those are referred to as factors, even though they're completely different meaning now. Now these are time t variables that forecast returns at t+1, rather than time t+1 variables that explain a lot of variance. That's the thing that there's a zoo of. And so what's going on now? There are literally, I think, at the last survey paper, I saw 340 variables that are claimed to forecast stocks. And if you thought DP, we only did DP. There's 340 like that. Not so much stock market over time as some stocks versus another. So earnings, size, book to market, and so on and so forth. Now that's a very different sense of the word factor. The third sense of the word factor is of those variables that forecast returns, can you then use those like Fama and French's HML and SMB to form factors that explain the variance of returns? So that's what's going on, and that I think in traditional asset pricing, making sense of that zoo is one of the prime items of research. We've talked earlier in the Hangout about the Fama-French now 5-factor model, which really they too would say, oh, and momentum too. They didn't include momentum just because momentum didn't matter for their portfolio sorts. And we're trying to make sense of these three different senses of the word factor and how are they all related. How do we really need 340 variables to describe expected returns? Of those, which really correspond to sources of common movement, factor in the variance sense. Oh, then there's pricing factor. That is factors in variance, exposure to which matters for expected returns. Industry portfolios are very important for variance. But exposure to the industry doesn't seem to generate, that beta doesn't generate a higher average return. So which of these common factors in variance matter for expected returns. I think I've just restated the question, but again, that's this is what's fun about this class. We get right up to the research agenda, and then I say, I don't know, you guys figure it out. That's where we are. The important takeaway here is to understand what the question is. There are different meanings of the word factor: factors in variance, factors in mean that generate factors in variance, pricing factors, namely factors in variance, exposure to which generates means. And our job is to sort them all out and hopefully one of these days get back to something simple like the capital asset pricing model. Nina, Adam, or Charlie, Igor, any follow-up on that? Everyone asks these big questions.
I have an opinion about what we should do.
You sure do.
But I like the state. I mean, I've thought a lot about this, and I think that. I think in a sense the Fama-French model is a model of means and variances, and we very much treat it as a model of expected returns. And by that I mean, if you add an unpriced factor to that model, such as an industry portfolio or some creative sort, that no one seems to care about it unless they think it prices assets, like unless they think it matters for expected returns. So I think, in a sense, we should try to cut through. All of the variance factors and just focus on the factors that explain expected returns. And so I did this in a way very much inspired by just reading John and sort of, hey, he says to do this in his textbook and this in discount rates, and I put it together, and maybe it's something new, but the basic idea is use everything you know about characteristics of firms to predict expected returns. For instance, we have just legions of work, 347 characteristics, I would call them, that tell us what a high return stock is and a low return stock is. And I would say put them all together and then ask the question, how do high expected return stocks behave relative to low expected return stocks? And stop thinking about stocks in terms of these characteristics like book to market, investments, momentum. And I mean, I'd love for anybody to read the paper and give comments. So it's one way forward. Maybe there are lots of others, but
what the rest of you don't know is Charlie has a wonderful paper on this topic. I will advertise as a breakthrough in trying to make sense out of this. And Charlie, where can they find the most recent copy of your paper?
It's on SSRN. I'm revising. I've gotten a lot of good comments because I got some great publicity that I wouldn't have otherwise gotten if not for John. But I should have a new draft up soon. But I think the main idea is there, and everybody's asked for 1 million robustness checks, which are all going well. So I'll post those.
What should they search for on SSRN to find your paper?
If you type in level, slope, curve, and Clarke, my name, C-L-A-R-K-E, you'll find it easily. And I can post a link to the Hangout for sure.
One thing, so to bring this back to our earlier discussion, remember the purpose of the model. I think what Charlie's doing is wonderful in this game of synthesizing down what pricing model do we need. But if you want a model of variance, if you want a model for hedging and you're not trying to price assets or explain expected returns, then factors in variance that are not priced are very important to put in. If you have if you own an internet stock, you want to hedge it with a tech portfolio, even if exposure to the tech portfolio doesn't generate average returns. So just always, what's a good model depends on what purpose you want to put it to. Yes. Adam, I think Adam is our MC. What are we doing?
Could I follow up on it a little
bit? Yes, please.
Just a brief one here. Say we take those 300 or 500 or whatever factors and we run a PCA on them. And imagine that we find out that one single factor explains, say, 85 or 90% of the whole variance, and we use this factor instead of the 300. How would that factor relate to the mean variance portfolio we talked half an hour ago, I guess? So would we get similar results or something? Thanks.
Well, thank goodness for the theorems, because I wouldn't be able to answer the question otherwise. We know that there's a single, you price assets if and only if you have a single factor, which is a mean variance efficient portfolio. So if you have a multiple factor model that prices the assets, then there's a linear combination of those factors which you can coalesce to a single mean variance efficient portfolio. Now, as Charlie pointed out earlier, that might not be that useful. Maybe you don't want the single representation, but it certainly that's one way of boiling things down. And then in that you would forget about the factors that explain variance and don't explain mean, which for hedging purposes might not be a good thing to do. Okay, on to the next.
Sure. Why don't I then, if John was allowed to make a shameful plug for Charlie, then I can make a shameful plug for John. You mentioned why it was that Charlie suddenly got publicity from John is because John mentioned this on his blog. So if there are any students out there who don't know of John's blog, it's definitely worth to go to johncochran.blogspot.com or just the grumpy economist among friends. But now, why don't we go to the...
one more plug for John? Like for those of us doing empirical work, look for his investments notes. Like he reads Fama Friends 2008, Novi Marx, and I think it's an MBA class, but I think reading the notes, if you're interested in empirical stuff, which I know a lot of us are, I think it's really, really rewarding to sort of go through those notes and listen to how he talks I think it's an MBA class through some of these really important papers in empirical.
So are you referring here to the notes? I have an MBA class called Advanced Investments that has...
Yeah. I think it's Advanced Investments, yeah, and you do, I know Fama Friends 1993, you do Novi Marx's Gross Profitability with Dissecting Anomalies and Betting Against Beta. I read a lot of these notes before this Coursera class existed, and I thought they were really useful.
Oh, well, you warmed my heart, because now my project of putting them on the internet paid off. I never knew before now that anybody had ever found them before. So for this class, we'll get the Fama French version. I have in sort of on my back burner is to put that MBA class onto Coursera as well, but that's going to be a long time coming given how long it takes. Making these quizzes is not easy, in case those of you who are scratching your heads at how long it takes to answer them. Making them up takes even more time. Okay, next question. Enough backslapping and self-congratulation here. Adam, give us a hard question.
Definitely. There's a question from Hua Sun who asks, "Hi, Professor Cochrane. This is Hua, and I do research on real estate-related topics. As you mentioned, P equals E of mx is supposed to work well for marginal investments, but not for big lumpy investments. For real estate, it is usually very capital intensive. Does it mean that we should not use P is equal to E of mx to think about real estate pricing problems at all?"
Oh boy.
Or alternatively, as well, we could argue that assuming we have a broad market for real estate securitization, real estate investments can still be treated much like a stock investment, and hence P is equal to E of mx approach maybe should be valid. So I guess one way to interpret this question is if an asset is very sort of persistent, it's a very doable asset, do we price, well, what's the difference between pricing the marginal increase or pricing the average price of an asset?
Okay, so my job is always to bring all questions back into what we've learned in the class. So let me remind you of the theorems. When does P equals E of mx apply? All that takes is absence of arbitrage. So P equals E of mx, yes, of course. The question is, what's M? What's the discount factor? And does the discount factor relate to somebody's marginal utility? Now, in understanding individuals' real estate purchases, really in thinking not so much about market price formation, but thinking about portfolio theory, you can buy one house, you can buy only one house. And so certainly the idiosyncratic variance of buying a house is going to show up in the individual's portfolio decision. In fact, it's kind of funny that houses, okay, little parentheses here, houses are terrible investments, in case anybody didn't know this. At least in America, and in our political discussions, taken for granted that investing in a house is the most wonderful thing in the world and the government should subsidize it. Houses are terrible investments. They don't produce any dividends. They depreciate. They have enormous amounts of idiosyncratic risk, highly leveraged. They're just awful investments because you have to hold that idiosyncratic risk. When you buy a house in one particular place, you're exposed in a big way to the variation in house prices. So in that sense, in the portfolio theory sense, you can't use standard portfolio theory. You have to think about buying or not buying a house as a big lumpy investment. On the other hand, there is a margin. You can always buy a bigger house or a smaller house. So thinking about that margin makes sense. So I've read some real estate models. So for example, Monica Piazzesi and Martin Schneider do some very nice general equilibrium real estate modeling. And in thinking about people buying houses, they don't just use CAPM portfolio theory. A house is one asset among many. They write a model where you have to buy one house, you buy only one house, and then you're exposed to the idiosyncratic risk. So in the general equilibrium, that's certainly got to matter. And then, when you think about house prices, they respond to market forces in very sensible ways. There is, how do they fail? There is momentum in house prices. When house prices are going up in places like California, where I am now, they seem to be, that it's fairly reliable to predict they'll keep going up. Why is that? Well, there it's not so much the lumpiness of the investment, but the transactions costs. What momentum shouldn't happen. Why? Because when people see stocks going up and think they'll keep going up, they should buy now, and the stock should go up now. But it's very hard to speculate on real estate. There's transactions costs on buying it. In many places, it's hard for businesses to buy huge amounts of houses and then resell them. So in a market that's slow moving like that, with transactions costs, you can see things that you can see patterns like momentum, even though it's perfectly rational, because you can't short sell a house. So you know, all the sort of short sales anomalies ought to and do show up a lot in housing. But you know, in large ways, you know, the Q theory works beautifully for housing. When prices are very high relative to rents, people build a lot of new houses. So you know, that P equals EF of X seems to work fine there, despite the assumptions not working so well. I'll leave it there and not give a long lecture on real estate finance, unless do the rest of you have something interesting to add on this topic?
No.
Unlike me, you're not willing to make it up as you go along, eh? Okay, let's see. Nina, do you have a question from the forum for us?
Yeah, the next question from the forum is from David, who lives and works in the New York City, and he has PhD in mathematics. He has a question about the very first equation in the book, that utility is equal to the utility of consumption at time t plus beta multiplied on the expectation of utility depending on consumption in t plus 1. So his question is the following: since I'm not an economist and I don't know the proper terminology, let me call it the intertemporal utility function, and just So he says, let me call the utility depending on Ct and Ct plus 1 the intertemporal utility function, and just U the one-period utility function. His question is, why should the intertemporal utility function depend only on the first moment of the future one-period utility function? I understand that one can get risk aversion to uncertain Ct plus 1 through a concave U, but why shouldn't people have risk aversion to uncertain future utility? Would you be indifferent to a bet that will lead to a large positive or negative change in utility just because the potential increase and decrease cancel and leave a zero expected change in future utility? I wouldn't. Who needs all the sleepless nights waiting to find out which outcome we'll obtain?
Yeah, this is great. Let me jump in here because I have an answer to that part already that I don't want to forget. David is showing off both his mathematical training, that he wants generality, and he just invented, which is pretty remarkable in a question here, Epstein-Zinn or recursive utility that generalizes this assumption. Now, for everyone who's listening, I'm going to write an equation here. Our general, you know, when we're mapping U of Ct plus 1, I'm going to write, hold on, I have to write an equation because talking about equations without writing them is kind of hard. So there's our equation that we're talking about, right?
Yeah, right, exactly.
And what David's pointing out is that this object on the left, it allows a lot more generality. This thing that I put up on the right is a very simple form. It assumes that the utility of consumption in the two dates is linearly separable between, and that the U's are the same form. And remember, actually, this isn't just two dates. This isn't just two objects. What we're really thinking about is utility is defined over, there's today is consumption T, and when we do expected utility at Ct plus 1, we're defining utility over consumption today and then consumption tomorrow in each of the various states. So this is a utility function defined over many goods, really. If there's n states, then this is n plus 1 different goods. And we're doing something very special in saying that the utility over n plus 1 goods is a separable function of the utility over each of the n plus 1 goods. Exactly right. Simplicity has its virtues. This is a special case. Now it's a special case in two ways. First, that we're using expected utility. Now that's not written in stone. That's just extraordinarily convenient. There are axioms which I've forgotten now under which expected utility holds, but there is non-expected utility. It's called recursive utility, and it has exactly the property that David intuited. Good job there. That in the expected utility, you don't care when you learn about things. You only care about the final result. So if something good or bad is going to happen to you a month from now, learning about it today, learning about it tomorrow doesn't make any difference. A preference for learning about things earlier results out of recursive utility that doesn't have this linear form. Okay, we're doing the simple linear one, not because it is. We're sort of, there's the joke about the drunk who's looking for his car keys near the lamppost, and why is he looking there? He dropped his keys down in the other part of the block, but here's where the light is, and that's what we're doing too. This is the simple form that we can really work with and get simple intuitive answers out of. You can write down all sorts of generality, and then you get big horrible formulas that you don't know what to do with. Or you write down generality and you get additional effects that may not be important to the problem at hand. So expected utility, this simple one, why are we doing it? Well, this captures for us the effects of delay, consumption today versus tomorrow, and the effects of risk aversion. We know those are important effects. If you want to add the effects of preference for early resolution of uncertainty, then you need to have some function here that is more general in how it combines C and CT plus 1 to capture those effects. But what we do, it's not productive in economics and finance research to write down the most general function and try to establish general results. It's more productive to write down special cases that capture effects that you think are important, and especially in a class. We teach human beings, so we start with the simple example and then we slowly generalize, rather than writing down the general space. You know, if for all mathematicians, what I should have said is our utility function is a function taking an n-dimensional vector if it's a state space or some sort of measure space into the real line, and talking about general properties, and then everyone would be lost. So we're going to do it the other way. Start with the simple intuitive one and then slowly generalize. Any comments? Adam, you're more of an expert on recursive utility than I am. Did I say anything wrong there?
No, I didn't hear anything wrong. I think it's important to think what is it that recursive utility gives us over just power utility. And the two key concepts to keep in mind is what's the difference between risk aversion, the aversion against bets, and what is so intertemporal elasticity of substitution, so sort of the aversion between having to binge eat at one point in time. And often when we simplify the utility functions in this course or in many introduction courses, those two concepts are related in an inverse matter, and maybe that's not sort of reasonable, and that's what you can get with Epstein's.
So let me summarize this discussion as an important piece of fatherly advice for graduate students. You don't write a thesis by just mindlessly generalizing, by saying, let's write down the most general thing and see what happens. It's not, that hasn't in the past been good productive research strategy. The more productive research strategy is try to think of the effect you want to model and it makes sense, and then write the minimal model that captures the effects that are important to you. That just seems to be what works in economics and finance. I think we have time for one short. Nina, do you have one short question you can pass on for us? And then we'll say goodbye.
Let me see. Okay, question from Lammertjan from Netherlands, University of Groningen. He said to me, it's not very clear whether a discount factor can price manage portfolios as well. Managed portfolios, yeah. And if it's so, if this is possible only conditionally or not.
In a frictionless market, a discount factor should price anything, right? And managed or not managed. So just for everybody else, this was the, I'm going to write an equation, ET of M, R, MT plus 1, RT plus 1. I find it always useful, try and think what theorem we have that applies to a question. And I'm just going to write a couple of equations to remind us. So the managed portfolio theorem says, right, E of conditional expectation of MR, that should be familiar by now, Since zt is known at time t, it can go inside a conditional expectation. And then, of course, we can group R and Z and take unconditional expectations. Then we interpret R and the multiplication of R and Z. You can interpret that as a managed portfolio, because what it is, these should be excess returns. Sorry, I'm allowed typos on my. These are supposed to be excess returns. So an excess return is a long-short position. If I just scale up the weights, that just means instead of borrowing $1 and putting it in a market, I borrow $2 and put it in the market. So Z times RE can be thought of not as an instrument, but as a managed portfolio. So now let's try to take that question and say, in the context of this theorem, what was the question? And I'm not sure now anymore. Maybe you could help me remember. So this shows you that managed portfolios should be priced. Now, Nina, help me out. What did the question ask about that theorem?
On the one hand, he says, I would expect betas to vary over time for managed portfolios so that it perhaps would only work conditionally. On the other hand, we test, for example, the Fama-Fresh three-factor model unconditionally for portfolios that are sorted yearly on size and market to book, which are clearly managed portfolios.
Okay. So now this is a right. So let's go back to the theorem. This theorem says if you have a perfect pricing model that prices everything conditionally, then of course then it should price the managed portfolios as well. Now the question becomes one more of, well, which kinds of models do you expect to work for which kinds of portfolios? And so let's think of a practical example. Momentum. There's a managed portfolio. So here's an example of the kind of intuition that I think the question brings up. We know, for example, that the CAPM works pretty well on size portfolios, and we know it's a disaster on momentum portfolios. So there's certainly a sense in which capturing highly managed portfolios, you need a discount, an approximate discount factor that captures something like more conditioning information. There may be discount factors like the CAPM that work for some kinds of portfolios and don't work for other kinds of managed portfolios. That's no longer a question about total purity, right? This is an M that prices everything should price managed portfolios. It becomes sort of a back of the envelope question. Well, which kinds of factor models do you find seem to work for which kinds of portfolios? Is it possible to use something like the CAPM for some kinds of portfolios, knowing that it won't work for others? And the answer there has got to be yes. So with that, I think we're done for the week. Thank you, everybody, for coming. This has been a great pleasure. See you again next week.
Thank you. Bye-bye.
Bye.
Nice to meet you. Igor, thanks. Bye, Adam and Nina.
Good talking to you.
Bye, John.